Introduction to Management Accounting. Management accounting, also known as managerial accounting, is a specialized area of accounting that focuses on providing financial and non-financial information to managers within an organization. It helps decision makers make informed choices related to the organization's operations, planning, and control. Unlike financial accounting, which focuses on external reporting for stakeholders, management accounting provides internal information tailored to the specific needs of managers. Definition and scope of management accounting. Planning. Management accounting assists in setting goals and developing strategies to achieve them. It provides financial projections, cost estimates, and resource allocation plans to support the organization's overall strategic direction. Controlling. Management accounting helps monitor actual performance against planned targets. It analyzes variances, identifies deviations, and provides insights to improve efficiency and effectiveness. Decision-making. Management accounting provides relevant and timely information to support decision-making processes. It analyzes costs, benefits, and risks associated with different options to guide informed choices. The role of management accounting in decision-making. Pricing decisions. Management accounting helps determine appropriate pricing strategies by analyzing cost structures, market demand, and competitor pricing. Product mix decisions. Management accounting analyzes the profitability of different products and services to guide decisions on product mix and allocation of resources. Investment decisions. Management accounting provides financial analysis, cost-benefit analysis, and risk assessment to support capital budgeting and investment decisions. Outsourcing decisions. Management accounting evaluates the costs and benefits of outsourcing specific functions or activities to external providers. Cost concepts and classifications. Direct costs. Direct costs are directly traceable to a specific product, service, or activity. Examples include raw materials, direct labor, and manufacturing supplies. Indirect costs. Indirect costs are not directly traceable to a specific product, service, or activity. They are incurred for general support functions or operations. Examples include factory overhead, administrative expenses, and marketing costs. Fixed costs. Fixed costs remain constant within a relevant range of activity levels. Examples include rent, salaries, and insurance premiums. Cost volume profit analysis. Break-even point. The break-even point is the level of sales where total revenue equals total costs. At this point, the company neither makes a profit nor incurs a loss. Contribution margin. The contribution margin is the difference between sales revenue and variable costs. It represents the amount of revenue available to cover fixed costs and generate profit. Profit margin. The profit margin is the percentage of profit generated on each unit of sale or on total sales. It reflects the company's profitability and efficiency. Budgeting and budgetary control. Budget planning. Budgeting involves developing financial plans for future periods, outlining expected revenues, expenses, and resource allocations. Budget approval. Budgets are typically reviewed and approved by senior management to ensure alignment with strategic goals and resource availability. Budget implementation. Budgets provide a framework for operational decision-making and resource utilization throughout the budget period. Budget monitoring. Regularly monitoring actual performance against budgeted targets is crucial for identifying variances and taking corrective actions. Standard costing and variance analysis. Variance type. Definition. Causes. Material price variance. Difference between actual material cost and standard material cost. Changes in material prices, purchasing discounts, or material quality. Material usage variance. Difference between actual material used and standard material allowed for production. Inefficient use of materials, production errors, or changes in production processes. Labor rate variance. Difference between actual labor cost and standard labor cost. Changes in wage rates, overtime premiums, or labor skill levels. Labor efficiency variance. Difference between actual labor hours worked and standard labor hours allowed for production. Inefficient use of labor time, production delays, or changes in production processes. Responsibility accounting. Performance measurement. Responsibility accounting assigns specific performance targets and measures to different levels of management, holding them accountable for their respective areas. Teamwork collaboration. Responsibility accounting encourages teamwork and collaboration by aligning individual and team goals with overall organizational objectives. Financial reporting. Responsibility accounting provides regular financial reports that highlight performance metrics and variances for each responsible unit, facilitating performance analysis and corrective actions. Capital budgeting and investment appraisal. Net present value (NPV). NPV is a method that discounts future cash flows back to their present value, taking into account the time value of money. Internal rate of return (IRR). IRR is the discount rate that makes the NPV of an investment project equal to zero. It represents the effective return on investment. Payback period. The payback period is the time it takes for an investment project to generate enough cash flow to recover the initial investment. Profitability index (PI). PI is the ratio of the present value of future cash flows to the initial investment. It measures the profitability of an investment project. Ethical considerations in management accounting. Integrity. Management accountants must act with honesty, fairness, and objectivity in their professional activities, adhering to ethical codes of conduct. Transparency. Management accountants must disclose relevant information in a clear, accurate, and timely manner, ensuring transparency in financial reporting and decision-making.